Beautiful photo, and everyone hopefully recognises this is Mount Everest. Now, I have no desire to climb Mount Everest, but people do, and they don't do it just on a whim or without some planning. And in fact, to climb Mount Everest, you've got a massive amount of planning. And you've got the first step is to decide what date they're going to go, who they're going to go with, what they're going to take with them, how they're going to get there, which side they're going to go up. There's more than one way to climb Mount Everest. So there's different options of routes to get up there, and what planning they're going to do ahead of time, what training they're going to do, what food they're going to eat. There's a lot of things that go into planning a climb of Mount Everest. Now, I'm not for a moment suggesting that running your business is like climbing Mount Everest, although for some of us, from time to time, I think that's a feeling that it does feel a bit like a long, hard slog going up and up and up and seemingly not getting anywhere near that summit. But it doesn't have to be like that. And it is important, though, that you are planning. And to do a plan, you need to understand what your starting position is. Where are you now? What are your current figures looking like? What's your bank balance? How much money do people owe you? How much money do you owe? What's the starting position of where you are? Be clear then on your existing gross margin. So I've talked about that a moment ago, but it's being clear on what is that gross margin. And again, from about page 100, I've got some more details of what the gross margin is, and some case studies on page 59 and 60. But what's important about understanding where your existing gross margin is identifying where you may be able to have areas of improvement. One of my clients that I've worked with has 3 divisions in their company. There's a couple of guys that own the business, and between them, they've always had differing views on which division was actually doing the best. We put some reporting into their system around the 3 divisions, and over a short period of time, it only took us 2 or 3 months, and we had a very, very clear picture. Of their 3 divisions, they had one that was an absolute standout on gross margin. It wasn't costing much to produce what they were doing. They were getting really good income on it, so their gross margin was really high, and they were doing extremely well. The second division, it was okay. For the industry, it was doing all right. It was, the gross margin was okay. And their third division basically was making them no money at all. So the costs of producing what they were doing and the amount they were charging and selling it off to their customers was about the same. So they really weren't making any money out of it. And what they understood from that, though, was in a sense they could get rid of that third division and make a lot more money because the manpower and resources that were used in supplying that third division could be better utilised in this high area division that was making them a lot of money. By having that information, they were able to make a decision. Now, in their case, they decided they would keep that division that wasn't making much because it was a lead generation into the higher selling parts of the business. But being able to focus in on that gross margin is important. I've got another client who sells one product, so it makes it really easy. And yes, if you've got multiple products, gross margin on each product, probably not. May just be average. Look at it, see whether there's room to move. But this one particular client, we've got them with just one product, and we've zeroed in on all the different components of the cost of sales. And we have identified areas that can be worked on to be improved. And slowly we are working on each area to get those numbers down so that the gross margin and gross profit is improving. And we've been doing it for a couple of months now, and we're already seeing some really good results on areas of improvement there because the focus is on it. So understanding where you start is good because it then allows you to decide where you're going to head for. Another good area to look for at is where you can save money. So this is a case of looking at every single expense you're paying money for, whatever you're paying, and asking the questions. Do I really need to pay for this? Not in the sense of you have to pay for it. Yes, you do if you've spent the money. But do you need it in the business? Is it adding any value to the business? Is it necessary for the business? Or is it something that perhaps you might be a subscription for something you signed up for a few months ago, a year ago, and you haven't realized you're still paying it and you're not utilizing it anymore? Or it might be something that you could look at getting the same thing but at a better pricing. So, I have a client at the moment who's doing a major review on some insurances, a business insurance, and they're reducing their premiums down to, I think, about 40% of what they were initially. And they just hadn't asked the question. The insurance premium came in every year, they just pay it. It is a big figure, it's a reasonable sized business, and we've been focusing on a number of figures in their business, and that was a big one that stood out. They've gone back to their broker and said, mate, let's have a look at these numbers. Can we get a better pricing on this insurance? And do we really need to cover everything that we've got covered? So they've done a full review. As I say, they've saved themselves, I think they've saved themselves probably around $30,000 to $40,000 a year. It was a big premium. So look at whether or not there's money you're spending you don't need to spend, or is there a cheaper, just as good option, but a less costly option to get the same result to save you some money. And then on the tip side of that is look at whether or not you've got any expenses you should be spending money on. So it may be that you really haven't been spending enough money on the marketing and you need to ramp it up to get your brand out there, to get more awareness, to get the local community to even know you exist, whatever that might be. So it's an opportunity to look for area of savings, an opportunity looking for additional expenses. Did a review with one client and we saved over $4,000 per month in costs that just had snuck in there over a few years, hadn't been looked at, hadn't been monitored. Some of it was some website type work that was a monthly fee, and the guys weren't doing anything. It was just an ongoing fee that had never been cancelled when the job had been finished. So easy for those things to happen, so keep a tight rein on it. And then I come back to, again, my take home. Calculate what you want for your take home. And this can be two numbers. So one number is the sort of the bare minimum take home that you need to have to pay the bills and to cover the rent, the mortgage, the food, the family costs, to be able to meet all those bills. And the other number, which is probably not the same number, is a higher number, which is what are you worth? What are you looking at as the amount of money you might have to pay if you paid somebody else to do your job? Or, as in I've got with one client, we've just been going through this exact review. She's identified that she wants to take home the same as she used to take home when she had her corporate job. Now she's not there at the moment. She's on the kind of bare minimum, keep the rent and food paid, but she wants to get to paying herself out of the business what she used to get when she was working in corporate world. What we've identified through doing the budgets and the cash flow for her is that she should be on track to increase her wages to that level in about August. So we've got a few more months of hard work to go, some more work and some things that need to happen but to get to that number. But she's got the focus. She really wants to take that higher take home in her pocket, and she knows what she needs to do to make sure that that happens. So what her turnover needs to be, what her expenses are, what she's agreed to pay. It's only when you've got all those numbers put together that you can start to prepare your budget. And I don't have time, unfortunately, in this call to go through the details of how to prepare a budget. It is a long process and a few hours worth of conversation and hard work to get there. But I just want to touch on those are the starting points to get there. There's a lot more information about budgets and cash flow, and I'm about to talk to cash flow in a moment, from page 75 onwards in the book. But so once you've got your budget in place, that's the first step. And from the budget, you can then start to look at a cash flow. So the difference between a budget and a cash flow is the cash flow is the detail of when the money is expected to be banked in your bank account, when you have to pay the bills. So there's timing exercises that come into account with your cash flow. With a budget, it's what do you expect to sell in the month? What do you expect your overall average expenses to be over the year? And it's a detailed number of what you expect the income and expenses, cost of sales to be. But it doesn't tie up with how much money is going to necessarily be in your bank account. For example, you could sell $10,000 worth of whatever it is you sell in the month of May. So last month you might have sold $10,000 to a particular customer. You've invoiced the customer. They didn't pay you in May. They'll maybe pay you in June, and you're probably more likely to get paid in July, let's say. So in your budget, you've got $10,000 of revenue in May, but in your cash flow, you've got the $10,000 of revenue in July. So it's looking at marrying up what goes when. So the first thing to look at to start you here is to look at your debtors. So that's again your accounts receivable and the debtor days. Now the debtor days is a calculation of how long it takes on average for your customers or clients to pay their invoices. This number needs to be as small as you can possibly get. So if you've got a large number, that indicates that your customers or clients are taking a long time to pay their bills to you, and that's not good because it doesn't help your cash flow. Your creditor days and creditors, that's accounts payable, so that's paying your suppliers. Yes, we all like to pay our suppliers early. Well, at least the small little guys we deal with. Maybe the big corporates, we're happy to pay them as late as possible. But we do want to look at those other little small businesses that we do deal with because they're relying on us paying their bills for them to pay their bills as well. So have a look at what your creditor days are. Yeah, ideally, it's nice to have the number low. Gives you the warm, fuzzy feelings that you're paying everybody on time and everything's up to date, and that's great. But from your cash flow perspective, it is worth looking at paying those bills when they're due, so whatever those payment terms are. If someone's happy to give you a 30-day credit, then pay it on 30 days. They're still happy, and you've got money in your bank account for that extra time, or you've got extra time in which your debtors to pay you for you to pay it. Then look at your cost of sales and expenses for payment frequency. So how often do you pay things? If you're buying products, you might buy products in bulk and buy them every couple of months when you run out of stock, so you don't have a monthly purchase order. Your electricity bill is quarterly. You may have some other bills that are quarterly. You'll have things like workers' comp, which if you've got employees, that is annual. You may have subscriptions that are annual. So you've got things that are paid at different times of the year, annual, quarterly. You've also got your BAS, so your business activity statement with your GST and PAYG withholding, your employees' tax. For many people, that's quarterly. For some people, it's monthly. When's that due? So you can look at the timing then of when those payments are due. And then identify any of the capital purchases. So do you need to buy some plant equipment? You need some new computers, new vehicles, you need some equipment for the workshop, whatever it is you do. You need some of those. And at the same time, do you need to have your loan repayments, to whether you're paying back a bank loan or whether you've borrowed monies from friends, family or fools and you've got a repayment schedule to them that you need to be looking after. So look at what the timing of those is so you can then from there start to prepare the cash flow. And that's a key figure, report to prepare to make sure that you're on track with where you want to be in your goal setting.